Right, so let's look at the second aspect of money market hedge, and that is money market hedge payment. So you saw that when it is we are receiving money under money market hedge, what we do is that we borrow the present value of the foreign currency now, and then we convert it to the domestic currency, then we deposit it to earn what? Some interest. So at the end of the period, when the money is brought, we use the money to pay for the loan that we borrowed, and we already have our money intact. So that is how the money market hedge is used. The second one is when we are making payments. So when we are making payments, what do we do on the other hand? So if the company is expecting to make some payments in the future for goods bought or services or service received, the money market hedge can be used to hedge against any unfavorable movement in exchange rates. So the following procedure will be followed. So here also we're going to follow the procedure. So let me go through and then explain it with you. The first one is borrow an appreciate amount in the domestic currency today. Listen carefully. Borrow an appreciate amount in the domestic currency today. So you want to pay some money in the future, but what you want to do now is to borrow your currency. All right, you borrow your currency, the domestic currency, an appreciate amount. Two, convert the borrowed fund to the foreign currency at a spot rate. So now what do? You borrow your money. So let's say Ghana and US, and we are owing a US company, and we are preserving ourselves against the Ghana cedis. So what we're going to do is that we will be requiring more Ghana cedis to pay for the dollar, since the Ghana cedi keeps depreciating. So what we do is that we go to the bank and borrow equivalent of whatever amount we're going to be paying. Then we convert it into the foreign currency, which is the dollars. That's the second step. Third step is that we deposit the foreign currency in a deposit account to earn what? Some interest. So here, example, now if you look at the example here, it's the same as the first example. So this time around we will say it's expecting to what? Pay. So the first one was expecting to receive $100,000, but this time around expecting to pay. Now, so as always, we've been giving the UK annual interest rate and then the US annual interest rate. So 6% against 9%, 11% against 14%. So here, and I always tell you that the smaller one is the deposit rate, and then the higher one is the borrowing rate. So when we are making payments, what is happening is that we're going to borrow our currency. Since we are in the UK, we will borrow at 9%. Now remember, it is in 3 months time, right? In 3 months time. So it's going to be 9% divided by 3, and then that is going to divided by 4, because that is divided by 4, because we are dealing with 12 months, so that we will get the interest rate for the 3 months. So let me do that workings here. So we borrow the pound, okay, at 9% divided by 4, and that gives us 2.25%. Okay, then we deposit it. We're going to convert that, so we deposit the dollar at, now when we deposit the dollar, we will receive what? The smallest interest rate, and that will be 11% over 4, and that is going to give us 2.75%. I hope you are seeing how the flip is working. So in the earlier example, when we were receiving money, we borrowed the foreign currency and we deposited it in our domestic currency. But when we are making payments, we borrow our domestic currency, convert it into the foreign currency, and deposit it to earn some interest. So once we deposit it to make an interest, at the end of the period, what happens is that the interest plus the money will be accumulated, so that we will use that to pay for whatever amount that we have borrowed in relation to that. So let's look at how we go with the 3-step, having with the exchange rate. So the first step, what we said is to borrow an appreciate amount in the domestic currency. So we are going to pay $100,000. So we're going to be borrowing some pound. So when we are borrowing pound, remember the pound rate is what? 2.25%. here. Now, when we borrow, what is going to happen is that we're going to deposit, convert it to the spot rate, and then what? Deposit. So when we convert it to the spot rate and deposit, we're going to deposit at this rate. Okay, so this is the deposit rate for the foreign currency. So it means that, so we could say how much money we're going to be borrowing. So present value deposit of the US dollars, and that is going to be $100,000 divided by 1 plus 0.0275, and that gives us an amount of 973,236. So this is going to be 93,000, not 900, 97,324. So what did we say was the first step? We said borrow an appreciate amount in the domestic currency today, convert the borrow to the foreign currency and deposit. But then, even though the step is like that, we need to find out about, you see, we're gonna borrow and then we will deposit the foreign currency. So we're gonna use that as the discounting factor to get how much money that we're going to be getting at the end of the 3 months. So we're going to be converting this into the domestic currency, which is the pound, so that we find out how much pound we have to borrow in relation to that. So we need to go there and buy, and so the company, the forex, will sell to us. And you know that the forex always sells at the low rate, and that is 1.4960. 1.4960. So 2, we need to buy, so we convert at low rates, and so the amount in pounds will be equal to 97,324 divided by 1.4960, and that is going to give us an amount of 65,056 pounds, right? Then this will tell us how much we're going to what? Borrow. So the company must borrow this amount. So they go and borrow. So in the borrowing, what's going to happen is that it's going to be, so amount to be borrowed will be 65,056 times 1 plus the borrow rate 0.0225, and that is going to give us a total figure of 65,000 or 66,520. So if it is about payment, we are going to make payment in the future. This is how we go about it. So at the end of the 3 months, what's going to happen is that this money, remember we are depositing it. So at the end of the 3 years plus the interest, it will be $100,000, and we will use that to pay for how much money that we have to pay in the dollars in relation to that. So that is what you have to understand on how we protect ourselves or hedge ourselves against the negative movement in the currency using money market hedge. So remember, follow the step very well. Make sure you practice this over and over again and understand how the techniques work, because the examiner is going to ask you, and if he asks you, you should be able to answer the question in relation to that. So we've looked at the forward arrangement, and then we've considered money market hedge. The first one is to look at currency features. Now the currency features is actually also a foreign currency derivative that is used by companies in order to hedge foreign currency risks. So what are currency features? A currency feature is a standardized market traded contract to buy or sell a specific quantity of foreign currency. So let me take that again. A currency feature is a standardized market-traded contract to buy or sell a specified amount of foreign currency. So if you look at it, you realize that the features is more or less also like a forward agreement. However, this time around it is standardized, meaning that there is a certain quantity that is fixed that you have to buy or that you can buy or you can sell in relation to that. Then also another thing is that it is traded, meaning that you with forward arrangement is not traded because it is over the counter. You go to the forex and tell them we want $100,000 3 months time. What is the rate, or give it to us as this rate. They agree and that's it. But with currency features, you can sell it because you can buy it and sell it, and the profit you make is what helps you to hedge yourself against the forex exchange. So you buy the currency features, then you sell it later on. So the buying and the selling, the gain you are making is what is cushioning you against the negative movement in the foreign currency. So what are some of the differences between currency features and then forward contract? I've given you two of that already, so let's go to that. One, for currency features is a standard contract, but forward contract is a bespoke contract, meaning that it has to be arranged between the bank and then the customer. Two, traded on the open market, that is currency features, is traded on the open market futures exchange, but forward contract is traded over the counter. So from the definition, I told you that we can trade forex, but we cannot trade um, we can trade currency features, but we cannot trade forex, meaning that a forex we arrange it over the counter, and that is all in relation to that. Third, currency features, contract price is in US dollars. Always currency features, the contract price will be in the US dollars. However, with forward contracts, the contract price is in any currency that is offered by the bank. So we can say we want the yen, we can say we want pounds, we can say we want euros, we can say we want dollars, whatever currency we want, that is how it will be traded. But for currency features, primarily it is traded in the US dollars. Fourth, currency features have flexible closeout dates, but forward contracts have a fixed date of settlement, meaning that with currency features, as long as you buy it, you can sell it anytime before the due date. But then with forward contracts, you can't just walk in anytime to say you want the currency or you don't want the currency. It is only on the date that we agreed that the transaction can actually take place. Then the fourth thing is that currency features are cheaper than forward, and forward contracts are relatively high premium as compared to currency features. So these are some differences we can talk about in relation to currency features. So if we say currency features are traded on the future market, what is the futures market? So a futures market is an exchange traded market for the purchase or sale of a standard quantity of an underlying item such as currencies, commodities or shares for settlement at future dates at an agreed price. So the future market is a traded market, just like the Ghana Stock Exchange market is traded market where there is a standardized, way that trading is done, that you can buy items such as currencies, such as commodities at a date and then sell them at another date. More or less like you're a broker buying shares and then selling the shares when the price go up in relation to that. So when it comes to currency features, there are a couple of terminologies that we need to understand in order to help us to be able to solve the questions. Now, if you are doing financial management level 2, you will not be required to do any workings on this because it's something that you just have to know the theory and the differences, because it's one of the areas that the examiner has been asking students on. But in advanced financial management, for the purpose of analyzing whether the company should use currency features. Now, one thing you have to note is that in the exam, or you may not have one method, the question will be given and the company has money market hedge there, they have forward contracts there, and they have currency features there. So you're going to use these three methods, analyze it, and find out which of the methods will help the company to really prevent itself against the negative movement in the foreign currency in relation to that. So the first terminology we need to understand is what we call the contract price. The contract price. The contract price is the fixed minimum quantity of commodity which can be bought or sold using a futures contract. So contract size is there. We're going to be looking at that one very soon. So it's the standard. So when we get it, you can be given a contract size that is at any time you can buy $1.2 million currency features. At any time you can sell 1.2 million. It means it is standardized. So you cannot have what you want. It is what has been fixed that you can get in relation to that. In general, dealing on futures markets must be in the whole number of a contract. So when you want to look at a contract size, it's always with the whole number. So if you're obtaining the number of contracts that you're going to get, if you get your answer in decimal, you have to always bring it to the nearest whole number. Very important. The next one is the contract price. Contract price. The contract price is the price at which the features can be bought or sold. Right? The price at which the features can be bought or sold. Third, the settlement date or delivery date or expiry date is the date when trading on a particular future contract stops and all accounts are settled. So that is what we mean by the settlement date. So if you buy a futures for 3 months futures which going to expire in, let's say, in March, that means that after March it cannot be traded, because once we get to the end of March, all the accounts relating to that particular currency features will be closed and will be concluded. So depending on how long we expect the money we expect to pay or we expect to receive the money, it is based on that range that we will buy the currency features as well in relation to that. Then also, a futures price may be different from the spot price, and this difference is called the basis. The basis, so we're going to be having the basis, which is going to be the difference between the spot rates and then the futures price. So we're going to give in the spot price for the futures, and we're going to give in the future price as well. The difference between these two will give us the basis. One thing you have to note also is that the basis is always for currency features, the basis is always the fourth decimal place. The basis is always the fourth decimal place. Now, all of these things are terminologies, are principles, concepts that you need to understand. We are about taking a question in a moment. We are going to take a question in a moment, and when we take the question and go through the steps, the stages, you will realize how all of these things comes to play. So let's look at this question quickly. A U.S. company buys goods worth 720,000 euros from a German company payable in 30 days. So let me sort of put the preambles up at once. So a U.S. company buys goods. So a U.S. company buys goods from a German company, right? In relation to that, and it is payable in 30 days, and the value of the goods is 720,000 euros. 720,000 euros. Let's see. The US company wants to hedge against the euros strengthening against the dollar. So the objective of the company is to hedge itself against, because the euro keeps going higher against the dollar, meaning that if we don't take any action in 30 days, we may be paying more than the $720,000. And so this is what the company wants to hedge against. Current spot is, so we've been given the current spot. as 0.9215 to 0.9221, right, per euros. Okay, per euros. It means 1 euro is this, 1 euro is that in relation to that. And the euros feature rate is, so feature rate has been given as 0.9245 per euro. Let me do that well. Per euro. The standard size of a 3-month futures contract is 125,000. So the size, contract size in this case, is 125,000 euros. In 30 days time, the spot rate is 0. So we've been given the spot rate in 30 days time. So this is now. Then in 30 days time, we've been given the spot rate as 0.93 45 to 0.9351 per euro. So always closing feature price will be, so this is the now and this is the future. So closing feature price will be, we've been given that as 0.9367 per euros. Okay. Evaluate the hedge. Alright, so let me go through the question once again. A US company buys goods worth 720,000 euros from a German company, payable in 30 days. Right. The US company wants to hedge against the euros strengthening against the dollar. Current spot rate has been given now as this, and then the futures has also been given as that. The standard size of a 3-month euro futures is 125,000 euros, and then in 30 days time the spot rate is going to be this, and then the closing futures price will be also this. The examiner is asking us to evaluate the hedge. So let's look at how we will solve the question. So step 1 is to set up the features. So step 1, we set up the features. Now the question we ask ourselves is, which feature must we buy? From the question we are told that there is only a 3-month features here. So even though the question is we're making payment in 30 days time, which is 1 month, the features available that we can buy is the 3 months features. Now we need to make payment in 30 days time. So what we need to do is that we need to buy features in euros, and we've been giving the euros features at this standard price or at a size of what, 125,000 euros. So we need to buy the currency features in relation to that. So which contracts must we buy? We need to buy the 3 months contract. Okay, we use the 3 months contract. What kind of contract do we buy? We need to buy the what? The feature contract in euros, certainly, because that is what we are paying. Because the currency you are paying is the currency's features you buy, so that you will sell it later on make some profit in relation to that. Then we need to ask ourselves, what is the number of contracts we need to buy? What is the number of contracts we need to buy? So the number of contracts will be equal to how much money we're going to be paying, 720, divided by the size for each contract, 125,000, and that is going to give us 5.76. But remember, I told you earlier that the contract size must always be a whole number. So we will run this to approximately 6 contracts. It means we need to buy 6 contracts in euros so that we can get the 720,000 euros. Then after we buy the contracts like that, 6 contracts, we need to then ask ourselves, what is the basis in here? What is the basis here, or what is the tick size here? So we're going to say that the minimum, so we put it this way, that the tick size or the basis is going to be the minimum price movement times the contract size. Minimum price movement times the contract size. Now, so what is the minimum price movement here? Now, always the minimum price movement, remember we said the tick is also going to be the 4th decimal place. So the minimum price movement is going to be 0.0001, 0.001 times the contract size, which was 125,000, and so that gives us 12.50 euros. Okay, that's going to be the minimum or the tick size. So the first step is to set up what the features. So in the setting up, we ask ourselves 4 questions. 1, which contract do we buy? Even though it's a 30 days contract or 30 days payment term, which means you need to buy 30 days features, what we have available is 3 months, which is 90 days. So that is what we buy. Then what type of contract do we buy? Since we are making payments in euros, we need to buy features in euros. That's the second thing. Then third, how many contracts of the euros must we buy? Since we are making a payment of $720,000, and then the size of the contract or the size of the features or feature size is $125,000, it means we need to buy approximately 6 contracts. Then the fourth thing we need to ask ourselves is, what is the basis or the tick size, right? And that is going to always be 0.01 as 1 tick size times the contract size, and that is 12.50. So that is the first step. We set up the features. Then the second step is to find the closing features price. Okay, so step 2, closing features price. Now, what is the closing features price? We've already been given the closing features price as it is. I'm still writing dollars here. As is 0.9367 per. Yes. So that's what we've been given. That's already. So that's the third step. Now, assuming this was not given, we would have to calculate it in relation to that. But since it is given, we use that for it. So once we know the closing, so we will buy. So look at the idea. We will buy the contract at this price, okay? Then we're going to be selling later on at this price. That is the opening and closing. And so let's look at the outcome of the currency features at the end of the day. So step 3 is the outcome. So how will the outcome be? First, we're going to have the outcome in the futures market. So the outcome in the futures market will be, first, the opening futures price. So we always buy at a low rate, and our buying was 0.9245. Then the closing rate, the closing futures price right here, 0.9367. So we buy at a low rate, sell at what? A high rate. That is what we mean by profits. So movement in ticks, which certainly is the profit that we are making, it's going to be, remember, it's always going to be to the fourth decimal place, and that is going to be 122 ticks. So that's the profit we're going to be making to that. So if we check it, how much will we get? So futures profit. The futures profit is going to be the number of tick, which is 122 ticks, times the tick size here, which is 12.550, which is the tick size, times the number of contracts that we're going to be buying, and that is 6 contracts. So when we check it out, we will be making a profit of somewhere around 9310 or 9150. So that's the profit we will be making when we trade in this currency futures. So that's the first thing, the outcome in the futures market. Then the second thing is the net outcome at the end of the day. So at the end of the day, the net outcome is that the spot rate, at the end of the day, when we actually pay the money, the spot rate when we actually pay the money, remember, because we are going to need the currency, when we sell the currency futures, we're going to have the dollars and we're going to give it out to them. So the spot in relation to that will be the $720,000, right, times 0.9351, and that gives us a total of 673,272. Then we made a futures profit. So the futures market profit is 9150, as we have up there. So the net benefit is going to be 664,122. So you realize that if not for the futures, we would have been paying this amount of money in 3 months' time. But then because we've made some profit on the futures, we will pay this money in relation to that. So this is what you have to understand about how companies use currency futures in order to hedge themselves against negative movement in foreign currencies. Now, so what are some advantages of futures that we can talk about? One, transaction cost should be lower than other hedging methods. So usually transaction cost is lower than other hedging methods. Two, futures are tradable and can be bought and sold on a secondary market, so there is pricing transparency. Unlike forward contracts where prices are set by financial institution. Now, so because futures are tradable, the market knows about the price, and so when you are selling, you are buying, nobody will be cheating anywhere. But then with forward contracts, the financial institution is going to set the rate at which they are going to exchange to you, and it will be exclusive for each institution. So that is also one advantage that the currency futures has over forward contracts. Then the third thing is that the exact date of receipt or payment of the currency does not have to be known, because the futures contract does not have to be closed out until the actual cash receipt or payment is made in relation to that. Some disadvantages we can talk about can be: one, the contract cannot be tailored to the user's exact requirements, as I mentioned. So maybe even though you need $720,000, you realize that you should have bought less than 6, but you have to buy out 6. So it is not tailored to your specific requirements. The exact amount you need, you cannot get it to buy because this thing is standardized and you buy it in that same standard. Two is that hedge inefficiencies are caused by having to deal in a whole number of contracts and by basis risk. So that is it. There is going to be some level of inefficiencies because of the whole number we are dealing with. So if we were dealing with 5.76, then it could have been efficient. But because the contract is standardized and we have to deal with whole number, the efficiency of the technique is going to be impaired. Third, only a limited number of currencies are the subject of features contract, although the number of currencies is growing, especially with the rapid development of Asia economies. So usually features contract is in limited currencies, even though now we have Japan, the Singapore forex market also sells some currency features. The US dollars is also selling, the pound is also doing, but it's still limited, not in many currencies as it is in forward contract, where you can walk to the financial institution and whatever currency you want, you can arrange with them. And then the last thing is that unlike options, they do not allow a company to take advantage of favorable currency movement. So if there is a favorable currency movement, the option, you've already bought it and you have to sell it in relation to that. So we've looked at forward arrangement, we'll look at money market hedge, we'll look at currency features. The next thing we want to consider is currency options. Currency options. So what is this? A currency option is a right of an option holder to buy, that is a call option, you know that, or sell, a put option, a quantity of one currency in exchange for another at a specific exchange rate, that is the exercise rate, on or before a future expiring date. Now, if you remember investment appraisal, when we were looking at options and we looked at the Black-Scholes pricing module, I mentioned that option is going to be important when it comes to risk management. So with currency option, this is where the holder has the right to buy a certain quantity, meaning that if we get there and then the currency is in our favor, we can decide the option to what? Lapse, or if it is not in our favor, then we can still go and exercise our option. For instance, companies can choose whether to buy a tailor-made currency option from a bank suited to the company's specific needs. These are over-the-counter or negotiated options, or a standard option in certain currencies only from an option exchange, such are traded or exchange options. So usually there are two types of options that are going to be available for a company. We have what we call over-the-counter or negotiated option. This is where we go there and we tell them we require a certain number of quantity of currencies and they can give us the option to buy it, or the standard option, which is traded, and we can go there and buy that one as well. Now, so one thing I mentioned to you is that when I was dealing with Rick's investment appraisal options, there is that in order to guarantee that you're going to be buying, you need to pay some premium to the option seller, the one that is selling the thing to you. So for instance, if you go to the bank that, hey, we want to negotiate with you because we will be paying some money in 3 months time, some $1,000, and so we want to negotiate with you so that you give us the option to buy the $1,000 at a rate below the exchange rate that will be there at 3 months time, and they agree, they would have to find out about our commitment level. So we need to pay an amount of money so that it gives us that right to exercise, and that is going to be a premium that we're going to be paying in relation to that. So let's look at an illustration on how an option can be seen. So for example, a company may buy a currency call option, giving it the right to buy a certain amount of currency, say $6 million in 2 months time, in exchange for selling at an exercise rate of $1.5. Buying the dollars at this rate will cost the company $4 million. So let me put those numbers up so that we get the idea in relation to that. So for instance, a company needs an amount of $6 million. So what a company will, in 2 months time, for sterling, okay, the pound sterling. So currently the exchange rate is that a pound is $1.5. So if we are going to buy $6 million, that means that when we convert it into pounds, 6 million in pounds divided by 1.5, that is going to give us 4.5 or 4 million pound, okay, at this time. Now, if the spot rate at the exercise date moves to 1.6, so this is the scenario now. If we buy the option that, okay, in 3 months time we can buy the option at this very price. If at the exercise date it moves to 1.6, what do you think will happen? It means we will be paying 6 million divided by 1.6, and that will be 375,000 pounds. Now, what will you do here? So if the spot rate moves to this, the option holder will let the option lapse and will buy the option at the spot rate. So you realize that when we buy this at 1.5, we'll be paying 4 million, but when we will allow it to lapse so that we will buy it at the spot rate 1.6, because we'll be incurring less cost. We'll be incurring less cost as a company in relation to that. But what happens if the exchange rate at the time we want to settle moves to 1.4, meaning the dollar is gaining strength? If it moves to 1.4, then the company will be paying an amount of 4,285,714. In this case, then we will exercise our option. Okay, we will exercise our option. So what we're saying here is that if, for instance, we have the option, the right to buy $6 million currency at $1.5. First scenario, when the 3 months reaches and we need the money to go and do the payment, we will go to the bank. When we go to the bank and the spot rate is now $1.5, meaning that the dollar has depreciated further, so it is to our advantage. So now when we buy it at the spot rate, we will buy it at this amount. So it's an option, not a forward. Now, if it was a forward, even though it has dropped like this, we will still buy it at 1.5. But because it's an option, the right we have and not the obligation, we will rather sensible buy it at the spot rate, incur less cost, and save us some $250,000. But when we go and the exchange rate is 1.4, meaning that the dollar is gaining strength. Once the dollar is gaining strength, when we buy it at the spot rate, we will be incurring more cost. So if that is the case, we will go and buy it at the option price that we agreed on, and we exercise the option in relation to that. But certainly there are some drawbacks of currency options that we can talk about. One, they have a cost, that is the option premium. So it's not free. When you go, you have to, even though you are given that right, you have to pay the premium. So the premium makes it to have a cost there. Then options must be paid for as soon as they are bought. So once you buy the option, you need to pay for it in relation to that. Tailor-made options lack negotiability. So for instance, once we arrange it with the bank, at the end of the day we cannot change it any longer. We need to exercise it in relation to that if we have to exercise. And then the last thing is that traded options are not available in every currency. So yes, tailor-made are available in most currencies, but traded options may not be available in every currency that we may look for. So these are the things that you need to understand about currency features. Now when it comes to swaps, swap is simply a formal arrangement, okay, between two organizations, all right, to exchange some currencies or to exchange some commodities. So for instance, if you are buying from you're buying, and maybe you are in Kumasi and I'm in Accra. Then in Accra, let's say for instance I can get fish here at a cheap price, and also in Kumasi you can get, let's say, banana or oranges at a cheap price. Now you want fish, I want oranges. So what we will do is that I will buy the fish here for you in my locally, then you will buy the orange also for you. Now you don't need the orange, I don't need the fish. At the end of the day, we will exchange. So I'll give you the fish and then you give me the orange. This is the idea about swaps. And the same thing happens when we talk about the issue about currency swap. With currency swap, effectively involves the exchange of debt from one currency to another in relation to that. So currency swap also take various forms. For instance, if you are in the UK and I'm in Ghana, or you are in the UK and I'm in the US, and you want to undertake a project or buy something in the US, and I also want to buy something in the UK, now I can borrow the dollar for you, then you will borrow the pound for me, then we exchange, so that I wouldn't have to come to the UK and borrow the pound to me, because when you are borrowing, they will see you as a local firm. When I'm borrowing, they will see me as a local firm. Then the currencies will be exchanged between the two of us, and then we will pay interest on each person's behalf, and any amount that is left is netted and transferred later on in relation to that. So these are the things that you need to understand when we talk about hedging techniques. Very, very important in relation to that. So in the next video, which is going to be the final lecture video, we will consider the issue about interest rates, risk also management, and look at the various things that we have to note there in relation to that. So I'll see you in the next video as we conclude on risk management.